Happy December 3rd. My name's Jessica Amir, a market strategist here with Moomoo. As always, it's wonderful to have your company. So dip buyers are back. They're buying into tech stocks, consumer, discretionary and industrials. And this is why the S&P 500 rose 0.3% overnight. And it also sent the NASDAQ roaring up 0.8%. Now the key pin-up index is up 7%, up off its November lows. We can almost call it a bull market. Bitcoin, meanwhile, has surged 6%. That erased yesterday's gain. And the king of cryptocurrencies, Bitcoin, is now up officially in a bull market. It's up 13% from its low. So both the NASDAQ 100 and Bitcoin, they're in bull markets, while the Aussie share market and Hong Kong's Hang Seng, they're lagging, but will they play catch up? That's a question for you. So why the rally in Bitcoin and why the rally in tech stocks overnight? Well, perhaps it's because the OECD came out. They basically raised their forecast for US and Eurozone economic growth for this and next year. That basically says a lot. Even though the OECD says, hey, global growth is expected to slow from 3.2% this year down to 2.9% next year, they are seeing more growth than previously thought. So that is enough for investors to see a tick in their sentiment, and I guess encourage a fuel of or to fuel up buying. So that's why investors bought back in. So in terms of standouts overnight or things that you need to be aware of, we saw Amazon rushing out its latest AI chip. That's basically to take on Nvidia and Google. And Apple shares, meanwhile, hit a new record all-time high. As for what to watch today, there's plenty to watch and consider. As always, one of those things is Aussie economic growth. We call that gross domestic product or GDP. That's out today. Another thing to be on your radar is that France's Emmanuel Macron makes a visit to China. So any announcements in China will be watched closely. But let's focus on what's happening and what we're seeing in markets right now that you need to consider. And that is that investors believe 2026 is going to be a very strong year. Here are 5 considerations for you. Firstly, investors believe the global economy will rebound. OECD says growth is obviously stronger than thought. The second consideration is that investors believe higher growth is on the cards for the share market. And this is basically coming from the fact that we are seeing higher earnings growth expected for the year ahead. This is thanks to higher productivity, AI innovation, and job cuts, all boosting company profits. As we stand, the NASDAQ 100 earnings are expected to grow at 17% next year, 20% the year after. As for the S&P 500 earnings, they're expected to grow 11% next year and 14% the year after. So if what I say is correct, earnings drives share price growth, then the long-term thinking is that markets can keep going up. And that's exactly what they've done throughout history. The third thing is that we are seeing investors believe, yes, the economy will grow next year. Yes, earnings growth will continue. So what are they doing? Well, they're buying into magnificent 7 tech stocks that have dipped and sagged. What we have seen, perhaps over the past 3 years of this bull market, what we've seen is that investors are buying the dip, and they have done throughout this bull market cycle on the belief that magnificent 7 stocks will recover. Of course, not all of those Mag 7 stocks have recovered and hit new records, but this is the thinking and on many investors' radars. The fourth thing is that we're seeing investors buying broadly into the market. Now, this is evidenced by the equal weight ETF. Perhaps one of those ETFs is by the ticker RSP. We are seeing this trade at some of its highest levels on record. In fact, it's trading at its 3rd highest level on record. Now, what is this ETF for those that haven't been across it before? Well, it basically tracks the S&P 500 companies and gives them an equal weight, as opposed to, say, the S&P 500's ETF, the flagship SPY, for example. If you bought into that ETF, the biggest ETF in the world, that gives you exposure to Nvidia, which is 8% of the market. Apple's 7%, and Microsoft is 6%. Whereas this ETF that we're talking about, the equal weight ETF, tracks the S&P 500 companies and gives them an equal rating. The fifth and final consideration is that we are seeing investors also buy heavily back into cryptocurrencies, believing that they will have a strong year in 2026 as well. Changing pace now to investments to add to your watch list. Let's kick off with Marvell. Marvell is a semiconductor designer and they released quarterly results to the market this morning and they beat expectations. So tick, tick, tick. They basically cited stronger demand for data center products, and that makes up 75% of their business. Marvell's revenue grew stronger than expected. It clocked almost $2.1 billion. For next quarter, they see revenue rising more than that, getting as high as $2.2 billion. The company Marvell also announced that they're planning to buy a chip startup called Celestial AI for $3.25 billion US dollars. Why? Well, it's in a bid to scale up connectivity for the next generation of data centers. And this stock moved about 2% higher at one point overnight after their results. And in post market trading, they are doing well as well. The stock is rated a strong buy among analysts. Let's move to Boeing now. Boeing was the biggest gainer in the S&P 500 overnight. And why is that? Well, for many reasons. The company is forecasting greater jet deliveries next year, and that'll lead to positive free cash flow for the first time since 2023. It's a huge change, massive change, of course, from this year's negative cash flow of about $2 billion US dollars. That's why Boeing shares jumped 10% in the session, then now up 32% in the last 12 months. And we are seeing analysts continue to maintain a strong buy rating for the stock. Boeing is also expected to reach $10 billion in cash generation, and that's the target they previously outlined. Changing pace to Ampol. This is a stock that we're watching for a couple of reasons. One of those is because the global oil price continues to come under pressure. We are seeing both crude and Brent slip lower overnight on expectations about oversupply, particularly if we do see Russian and Ukrainian peace talks go successfully. We are seeing both the oil prices be down about 15% year to date, but of note, Ampol is going the other way. Their shares are up 12% this year, and yesterday they rose about 1.7%. Why is this? A couple of reasons. Well, the stock recently entered an earnings upgrade cycle, and this is because they are basically returning to profitability for their Queensland operation. And this is exactly why several analysts have come out changing their rating of the stock. One of those is Macquarie. Macquarie increased their price target for Ampol, rising it as much as 13%, giving it a $36 price target for the petroleum giant, saying it should outperform. There's plenty to watch and consider. Thanks for your company.